at 10 a.m. The way the course is organized is there's a lecture and then there's a Q&A afterwards, so please hold your questions until the Q&A session at the end, unless an instructor explicitly says they want questions during their talk. I will also take questions from the streaming audience. To ask a question, please use the Twitter hashtag pound YCSIS, and we'll take as many of those questions as we can, time willing. So there's a mixture here of, watching the class, of accredited and non-accredited investors. For the accredited investors, as most of you know, we are going to be extending an invite to YC's Winter 2018 Demo Days, which are March 19th and 20th. It's a virtual invite, and you can watch it online. But also, as a cool little kicker, we're going to invite randomly 10 of you to come in person to YC Demo Day, which is kind of a pretty special occasion, and I hope whoever comes enjoys it a lot. So, this is our first time teaching this class. Hopefully not the last. We do ask you guys to give us feedback for what worked, what didn't work, what was too obvious or too subtle, what was missing. At the end of the class, there'll be a survey. I'll say this again at the end. But please do give us feedback. You can also give us feedback real time as you like. You can email me at Jeff, GEOFF, @ycombinator.com anytime you like. Honest opinions are great. I want to start off also by pointing out I won't be up here very much. It's mostly a bunch of instructors from inside and outside YC. They're all volunteers, and they're very busy people, and they've been gracious enough to donate their incredible experience and time to us, and I'm very grateful for everyone who agreed to do this. Before we get started, I wanted to spend a couple of minutes talking about why we're doing this. How many of you have made angel investments before? Could you raise your hands? So you don't need any of this crap. You guys have already done this. Okay, so there's a lot of experience, and we know there's a lot of experience, but we're doing this for mainly two reasons. One is that angel and seed investors are a critical part of the startup ecosystem. It's the first money in usually. It's what allows companies to actually take flight and become real, big, interesting, scalable companies. It's also a little self-serving. We think that more great angel investors, great seed investors are great for YC companies, and we hope you will invest in YC companies. We also think it's good for you, for people who all of you who have invested. You know, it's an amazing way to get a window into the future, to be part of this future that founders are really creating, to get a window into what's going to happen. So it's all good. What are we hoping the outcomes will be? Venture investing has been around for, depending on how you look, hundreds of years, but really the kind of venture investing that we think of in Silicon Valley for the last 50 years. This guy named George Dorio he was a VC, he was an early VC of this firm called ARDC, and he made what we'd consider a seed investment of $70,000 in 1957 until this new tiny computer company called Digital Equipment Corporation, sometimes called Digital, often called DEC. And that $70,000 turned into $35 million, which a lot of people found pretty interesting. That led to what kickstarted an incredible flowering of innovation and a lot of wealth creation that has never seen the like in the world. And we hope that some of you all have that same experience, hopefully investing in YC companies. It's still possible. And there's lots of examples, and if we're lucky, some of the folks who are going to talk to you will give you some of those examples. So we also hope that you're all going to be better, smarter investors after this course. I'm sure that's why some of you are here. Some of you are here to get some of those insights, and I'm sure also that you will tell us if we achieved that goal. And lastly, we want to create a permanent repository of this information. So anyone can make use of it in future years. So we hope to make the repository better and better. And in fact, if there's anything that you can look at this online at investors.startupschool.org. And if there's anything you think we should add, just mail it to startupschool@ycombinator.com. And we'll look at it. And if we like it, we'll add it. OK. Very briefly now. We have 4 days, about 10 hours. So we can only cover so much. This is going to be about the fundamentals of startup investing. There'll be a few deeper dives, but not that many. We want to hit the major points. Kind of like an investing 101, I guess. We will start off with fundamental questions of why, how, and which companies. And that's today. And then we'll talk about the mechanics of startup investing. Clearly, many of you know these mechanics, but I think we'll cover it perhaps in ways you haven't seen before. Then we're going to walk through some of the dance that you have to do to make your decisions and to talk with entrepreneurs and founders and figure out which are the companies that are going to be part of your investing future. We're going to hear from a bunch of extraordinarily experienced and talented, at least by the results, investors during the course. And then we're going to complete with a little bit of context and a little bit of a look towards the future of startup investing. Startup investing has changed radically over the last decade, and I think most of us expect a lot more changes in the next decade as well. And in the end, we'll finish up with a conversation about the role that you all can and may want to play as you think about your role as an investor and what that means. I hope you all make it to the end. I think it's going to be really useful, and I think we have a pretty great lineup of instructors that'll be very relevant and useful to everyone. So with that, I'm going to turn it over to our first speaker, Sam Altman, the president of Y Combinator, who actually had the original idea for this course, so I'm pretty grateful for that. And he's also the man who has said, you want to sound crazy, but you want to actually be right. Sam?
Thank you, Jeff. And thank you all for coming. It's cool to see so many people in the room. So I want to talk about why, how, and what to do to invest in startups. I'm only going to talk a little bit about why, especially given how many of you already invest in startups. But I did do something to get ready for this class, which was I asked some of the best investors I know why they invest in startups. And I oh, Stephen, I think it's automatically advancing. No problem. So, and then I compared that with reasons I've heard from other people who I don't think are as good. And I think it is worth thinking about why the people who have sort of done the best in the field, what their motivations are to invest. Perfect. This was one I heard from a few people, these exact 3 words from a few different people. And this resonates with me. The thing that I like the most about investing in startups is that it's energizing. I feel like I am constantly working with people that are not burned out on the world at all. They have unlimited energy. They have new ideas. And they have the sort of the beauty of inexperience. And they don't know. You're people that are doing things for the first time are willing to do things that anyone who has got a few more battle scars won't try. And that is incredibly energizing to be around. Help shaping the future was something that the very best investors said again and again. And as part of that, the leverage on time, the ability to work on multiple things, came up again and again and again. Most of the time, you lose 1x your money, but occasionally you do get to make 100 or 1,000x, and that, for the same reason slot machines are so satisfying, is incredibly addictive. It's also satisfying because every once in a while, a founder of a great company who is now super famous will tell you, hey, that thing you did for me 8 or 10 years ago was this make or break difference to my entire career. and that's deeply gratifying. You get to be around some of the most talented people in the world. There is this sense of just endless optimism around the future that is really important to my own personal happiness to be around. And I haven't found that in too many other places in the world besides startup founders. It's incredibly humbling. I write on the back of every stock certificate on a Post-it note my confidence interval and what I thought was going to happen with the company. And you get used to being wrong a lot. And that framework, that mental adjustment that you're usually going to be wrong, that has been helpful to me in everything else I've done in life. You do learn a lot, though. And if you treat this as something that you're going to try to get better at and sort of deliberately practice, you can learn a lot, and you can get better at this really quickly. All right, so now I want to move into the two main sections, the how and the what. The number one mistake that I used to make when I started investing was actually not a misunderstanding of the power law. The number one mistake was that I cared too much about what other investors thought. And the sooner you can free yourself of this, the better. I think this is a very common mistake that people make when they start investing. You get very swayed by what previously successful investors think. The first question that most people ask YC startups is, who else is investing in your round? People totally outsource. I would say 80% of investors outsource 80% of their decision making to what other people think about an investment opportunity. But the problem is everyone does that. And so there's this weird schooling effect where a company gets hot for no discernible reason, or it fits a trend or whatever, and then everybody wants to invest in one company. And it's just because a few people decided they liked it. So the number one mistake I made was to be too swayed by what other investors thought good and bad about a company. After I corrected for that, the second biggest mistake I made was not understanding the power law. The power law means that your single best investment will be worth more to you in return than all of the rest of your investments put together. Your second best will be better than 3 through infinity put together. And this is like a deeply true thing that most investors find. And this is so counterintuitive that it means almost everyone invests the wrong way. So the question that you should be thinking about, the question that most people think about when they start angel investing is, can I hit a bunch of singles? And in most other kinds of investing, that's the right way to do it. If you're going to invest in stocks or bonds or whatever, that's how you do it. You just compound singles for a long time. But angel investing is a business of home runs, and you want to look for things that can be potential home runs. And we're going to talk about that again and again through this. But this is, I think, the most important thing to learn, and the thing that most investors get wrong. So it's all about the magnitude of your biggest success. It is not about the failure rate. Most investors talk about their failure rate. Still, when we have people that are trying to build angel firms come talk, the first question they ask is, what is your failure rate? What's an acceptable failure rate? Totally the wrong question, totally the wrong way to think about angel investing. You can have 95% of your investments fail if one of them returns $1 billion, and you'll be totally happy. And so this is what you want to think about. The first question that I try to ask myself when I meet a startup is not, why is it going to fail? It's not what could go wrong. The first question is, how big could this be if it works? Can I imagine this founder, this idea, this market supporting a massive, massive company? And then I think about all the things that could go wrong. But I found that if I thought about what could go wrong first, I filtered out the companies that could be giant. The companies that could be giant are at this intersection of sounds like a bad idea is a good idea. And because that's a very narrow intersection, and because they sound like a bad idea, the best investments are the ones that are easiest to talk yourself out of if you start off thinking about why they could go wrong. So then there's a question about, how do you find these companies? How do you find the companies that can be the handful of companies that get started every decade that are responsible for almost all of the returns? Just to put some numbers on the power law, YC has funded, I think, around 1,600 companies, maybe 1,700. Our top 5 companies represent about 2/3 of the value that we've created. And our top 1 company represents about 1/3. So this is like or nearly 1/3. So this is like this very extreme, very counterintuitive thing. All right, how do you find these companies? Another thing that I think is surprising is many of these companies that are sort of a generation-defining companies are started by people who are out of network, who are not well known, who are not sort of the people that can start a company and get a bunch of press right away. And so you have to find these, and the best way to do that is from other founders. This is part of what we try to do at YC, is we try to get our founders to like us so much that they refer all of their friends to us, because they say that these, YC creates so much more value than it takes. You got to go work with them. And this idea of like word of mouth as the way to find companies to invest in has been great. If you're just starting out, I think what I have seen the most successful angel investors do is just start helping founders for free, realizing they may not get to invest in those companies, but that they'll get the referrals down the road. And so much of this is about people connecting you to other people that you don't know. We talk about this at YC, this value of an open network. A lot of angel investors like to brag about how difficult it is to get a meeting with them, how you have to have a connection, otherwise they'll never take you seriously. And it's got to be from someone they worked with a bunch, and you've got to be well known and experienced. And we just make it really clear. Anyone in the world can go to our website, click apply. We try to respond to emails to people that email us. We take people seriously that have no personal brand, no reputation, no network. We ask people that are in our network to connect us to the most promising people they know that we don't already know. But this idea that we're available and we're open, I think this was in the 2 or 3 most important secrets of YC. This was something that we did that was really different. Other people hadn't done it before. In fact, people bragged about the opposite. And we went totally the other direction, and I strongly recommend this. Be open to that random email that comes in. Be open to the introduction of someone that on paper doesn't seem like that there's someone you want to meet. 9 times out of 10 you waste your time. That other time makes it totally worth it. So one big shift that's happened in the last 10 years, I'd say, or maybe 15 even, is there are now way more people that want to invest in good startups than there are good startups. And so founders have really become in the driver's seat. Founders of good companies have a lot of choice when it comes to investors, and founders talk a lot now. The network has gotten big enough that the asymmetry that used to exist, where investors had a lot of leverage, is gone, and I don't think it will come back anytime soon. Your reputation matters a lot. It is way more important to your future success as an investor that founders like you and say, that investor did the right thing by me, than it is that you squeeze out, a few drops of juice from a failing company. The number of investors that I have seen do incredible long-term damage to their reputation by fighting over the carcass of a company that was never, because of the power law, going to matter to them anyway, but try to get out, $10,000 or whatever from a dying company. If you're playing the long game, that's not worth it. Reputation, especially reputation when a company is going badly, is super, super important. And I think that is the secret at this point in sort of 2018 Silicon Valley to winning deals. The thing that we tell founders to do, and the thing that founders do anyway, when they're trying to choose between a number of investors that all want to invest in their company, is they do reference checks on you, just like you do on them. And more, the thing that I have seen founders use as the criteria to make the decision about which investors to work with is what the other founders that investor is funded have to say. And so I think this will continue to be important. There are other things you can do. I think helping before you close the deal is good. Deciding quickly, being clear about your reasoning, being responsive, being available, all the things you want from a founder, those all help too. But this reputation of being good to work with, that goes a long way, and people remember that for a long time. The other question I get all the time is, how do I get a good bargain? Like, how do I get a better terms than everybody else? We recently had a company. They had, let's say, 10 investors that were going to join their seed round. Every one of the 10 had asked for advisor shares. Every one of the 10 had said, well, unlike all those other investors, I really do work super hard. I'm the only investor in a round that usually gets advisor shares, so you need to give them to me to participate. And everybody asked for this, all 10, same thing. I'm the only one, I need advisor shares. And I think a lot of people are just looking for a good deal because valuations feel high. They have felt high to me for 7 years now. I went back and looked at my best investments. The very best investments I've made have either been a ridiculous deal because no one else wanted to invest, or a deal that felt incredibly expensive. The more I was willing to sort of overpay in my mind to invest in a company, often the better it did. And especially when I felt like I was getting screwed. If it was like a huge up round 3 months after some other round, it was painful. I did it anyway. I think because the companies that work sometimes work so fast, and you're anchored to like what a fair deal is, you got to watch out for this. But my experience investing in startups is my best investments, with 1 or 2 exceptions, have been the deals that felt the most expensive to me. And the 1 or 2 exceptions were companies where I understood something that no one else did, and thus there was no competition whatsoever. Other than that, the companies where I like tried to value invest have not been as good. I think value investing is not a winning strategy when it comes to being an angel investor most of the time. All right. I will try to go kind of fast through this to leave time for questions. So there's a big question of what to invest in. And here is the framework I use. I will consider anything that I believe could be a $10 billion company. And that is such a tight criteria, I have no other rules. So I am willing to look at any stage. I'm willing to look at any sector. I am willing to look at any business model. There are other investors who have this like, oh, I only do this one thing at this one stage. And maybe they make that work. I have never figured out how to do that. The great companies, the companies that are in that #1 spot on the power law are so rare that I suggest you only select for things that can be there. And other than that, be really open-minded. Speaking of the really big companies, I think, I don't know if this was always true, I suspect it may have been, but I think today it is easier to start a hard company than an easy company. And this sounds super counterintuitive, but if you're going to build a really big company, you got to convince people to come work with you, to pay attention to you, to write press articles about you, to care about you, to advise you. And if you are starting the 22,000th photo sharing application, it's really hard. If you are starting a nuclear fusion company, a lot of people want to help with that. And I think, especially for the companies that end up breaking out, this is really important. This thing that is so interesting, people proactively want to help you for free, want to come be part of your team, whatever. This is something to look for. So like, is this a company that I believe will be able to recruit hundreds of really talented people who could otherwise start their own companies? Is a super important filter that I don't think people think about enough. One thing that we've learned at YC is to mostly pick the founders. It is difficult to hear an idea at the very early stage and say, yeah, this idea has what it takes to be a $10 billion company. You can say an idea doesn't have it, which we'll talk about, but it's difficult to say this is for sure the big idea. However, I think you can, with practice, identify founders, and I'm going to talk about how, that have a chance at creating one of these companies. Paul Buchheit, one of our partners, made a list of the 4 traits that he thought founders that go on to create giant companies have, and they are obsession, focus, frugality, and love. He said this sort of in passing in a meeting like 2 or 3 years ago. I've thought about it a lot since. There's other obvious things that everyone screens for, but pay attention to these. Speaking of the obvious things that everyone screens for, intelligence is really important. You can give a founder an idea, and they can start a company. The problem is they need to come up with new ideas for a company. Basically, like every week, you have to come up with crazy new ideas, big changes all the time. We tried an experiment once at YC where we funded 20 teams of strong founders that didn't have ideas, but were otherwise really good. And what we learned, they all failed. And what we learned is that the good founders are the people that have ideas all the time. So there's an intelligence component to this. There's a creativity component to this. There is an ability to think independent thoughts component to this. But whatever you want to call this idea of this particular kind of intelligence that leads to seeing problems in different ways and thinking of ideas that don't yet exist but should, you got to have that in a founder. communication skills, I think, are one of the most important founder qualifications that people don't think about enough. So much of your job as a founder is about communication. Every time you hire someone, every time you go raise money, every time you try to sell the product, every time you try and set a direction for the company, you do it. Like, a huge amount of a founder's job is being an evangelist for the company. And if you don't have really strong communication skills, or if you don't develop them quickly, you're at a big disadvantage. Think about, there are obviously famous exceptions to this, but if you think about it on the whole, the founders of the really super successful companies tend to be great communicators. Execution speed. There's a lot of ways to measure this, and we talk about this a lot, the need to sort of relentlessly execute as a founder. This is incredibly correlated with success. So one way we test this during YC is between office hours, which we have every week or 10 days, how much progress do the founders make? How quickly do they take a new idea and try it and say, hey, I came back and I tried that. This didn't work, but this other thing did. In the process, I had these 3 new ideas. I tried those. Just this relentless cadence of execution is incredibly predictive of success. And we had a joke once where there were all these founders who are incredible on paper. They never execute quickly. They always have great reasons for why they didn't. But they still never go on to be successful. And then there are these people who just like get an amazing amount of stuff done. Their iteration speed, the speed with which they can have generate a hypothesis, test it, and implement it is unbelievable. That's really correlated with huge success. The rate of improvement of the founder. So if you look at a founder who comes to meet you for a seed round and compare that founder to Brian Chesky, you'll be disappointed 100% of the time. That is the wrong comparison. You will never write a check. However, just like startups, you look at the growth rate, you should look at the growth rate of the founder as well. So one thing that we can often tell over the 10 weeks of YC is how fast a founder is improving. This is different than how fast the business is improving. And, like humans always underestimate exponential growth. We're not well evolved for that. And so if you notice a founder who is improving incredibly quickly over the couple of months you get to know that founder, pay a lot of attention. Again, you won't get Brian Chesky in a first meeting, but you can find people who are on a trajectory to develop into a Brian Chesky. And that is super valuable. This is one of those things where I have seen it, maybe like 10 times in my career so far, where I just knew that this founder was going to like develop into an incredible leader. And it's basically been, every time I felt it, it's been right. I really do trust this rate of improvement metric. I think one thing you have to be increasingly aware of are the wrong motivations. So starting a startup is a very long-term commitment. If it's going to work, it takes more than a decade. It's really hard. There are a lot of days where you just want to give up. And there are a lot of people now who start a startup because they think it is a way to get rich quickly. And unfortunately, it's just not. So as startups have become the new default career trajectory for ambitious people, there are a lot of people who are doing a startup as a resume item or as a way to get rich quickly. This does not work. The amount of pain that you have to suffer for a startup, you realize at some point, you know what, I can do pretty well in any series of other jobs with much less risk and much less negative effect on my life. So you really do want to stay focused on the mission-driven founders. Again, if we look at our own success and failures in our portfolio of YC, every time we thought a company was going to go really well and didn't, the founder did not have this deep sense of mission. So it's something we really look for as a primary motivation. And then another way I used to get tricked a lot is there were founders that I didn't think were that good, but they had stumbled on a nice business. Or they had this metric that was growing pretty well, or all of my other investor friends were investing, and so I got scared and did it anyway. But But I think this focus on truly exceptional founders, like people that I'm like, wow, I want to go work for him or her, is really important. I have never once made a lot of money backing a founder that I thought was only okay, but a business that was otherwise good. I talked a little bit about this, but we have a word at YC called Scenesters. This is different than people who just want to make a lot of money. There are an increasing number of people who just like want to be around startups and go to startup parties and talk about being a founder. Treat that as a red flag. Obviously, low integrity people. That doesn't work out either. Okay, this is maybe the third biggest misunderstanding I had, and I think for many people, it's their number one biggest misunderstanding. People always say that what matters is not a startup's current revenue, but its growth rate, and that's true. However, in the same sentence, investors will say, but the only thing I care about is the size of the market today. And this is obviously ridiculous on its face, right? Like, if you think about the biggest companies today, 10 years ago, many of those markets did not exist. If you think about the size of the social networking market when Facebook started, if you think about the size of ride-sharing apps when Uber started, that's a really bad metric. And unfortunately, it has become dogma among investors that, size of the market is the most important thing. Even really good investors say this. I think they actually mean what they care about is the size of the market in 10 years, but they don't say it that way. And what you should care about, of course, is the size of the market in 10 years. If the market is huge today, first of all, you probably have a lot of big competitors already going after it. Big companies are doing that. Second of all, you don't get to surf this wave of this new technological change that pulls startups along and creates a ton of value in a short period of time. But you should prefer a small market growing super quickly to a very large market today. Super counterintuitive. If you chase the things that worked in the last set of companies, which is what most investors do, Facebook works, so they all want to fund more social networks. Uber works, so they all want to fund more ride-sharing apps. That is much harder to do the second time. It's far better, but more difficult if you can identify the next rapidly growing market and invest there. This is where independent thought is really important. If this is not something where you can just sort of follow what everybody else says by definition. You've got to learn to form your own thoughts about what the next really big market is going to be. One way that I like to do this, one way that I like to say, is the market growing really quickly, is to think about this question of whether something is a real trend or a fake trend. And I'll talk about that in a second, actually right now. Okay, so it has almost become a joke to make fun of like angel investors moving like a school of fish after one, declaring something as a hot trend and then 2 years later never talking about that again and saying, well, that just didn't work. But so there's this question, but sometimes they're right. Investors in Silicon Valley as a whole, for example, got mobile right as a thing in a big way. But then they got most other things in the last 10 years wrong. And I think every time someone talks about a big trend, my first reaction is skepticism. And I suggest yours is as well. Okay, but how do you differentiate between a real trend and a fake trend? A real trend is one where, although not that many people are participating yet, the people who are use the platform a lot every day and tell their friends spontaneously how great it is. So when the iPhone came out, most of the mobile industry would make fun of it because Apple only sold 1 million or 2 million, whatever it was in the first year. But if you talk to anyone who had an iPhone, they would say this is the greatest piece of technology I've ever had. People used it like many hours every day. It was absolutely life-changing. So even though the number of people that had it were small, you could identify that as a real trend because the people who had it were not only like daily active users but hourly active users, and they were the best free advertising Apple could ever have hoped for because they told everyone like this is the future. You've got to buy it. If you contrast that to something like, I got to pick on somebody. I'll pick virtual reality. If you contrast that to virtual reality, everyone talks about it as the next trend. It may be in the future. But today, if you talk to people who have VR headsets, they don't use them every hour. They don't use them every day. Most of them don't use them every week. They sit on shelves. That has clearly not become a a real trend platform yet. It may in the future. And the point at which people that you know, or a lot of people you know, a small number of people you know, even start putting their headset on for hours every day and telling all their friends they've got to buy one, it's the greatest thing in the world, that is the time to start investing heavily in VR. Can you pick that back up? So this question, are people actually using the platform, I think is a really important one when you're trying to think about, the next technology wave. And you do want to try to figure this out. Certainly not all, but most of the biggest technology companies get created soon after one of these massive platform shifts. Sequoia says this thing that I've always liked, which is you cannot create a technology wave. That is well beyond the capability of a small company to do, but you can surf one if you can find the wave. And I think that's really important. And I think it's actually, like, if you use this framework, pretty reasonable to evaluate. Okay, so I mentioned this a little bit earlier. What you are looking for are good ideas that look like bad ideas. These are things that you can articulate. There is a reason that this is going to be huge that most of the world is missing. Unfortunately, what most people end up chasing are bad ideas that look like good ideas. I would say this is where like 90% of all angel capital in the startup ecosystem goes. So this is something that is worth trying to avoid. And the one very common way that people make this mistake, bad ideas that look like good ideas, are chasing the thing that worked 2 years ago. And so if you ever find yourself doing that, be very skeptical. If you find yourself tempted to invest in one company where there's hundreds of others working on the same thing, be very skeptical. If you find yourself tempted to work on something that the founders work super hard to convince you is not going to be a long-term commodity, be very skeptical. The more people talk about, like, it is absolutely true that you want something that has real pricing power that comes from a network effect, a moat, a barrier to entry, whatever it is. But the more founders try to, like, when that's true, it's so obvious that the more founders try to sell you on why they're super differentiated and why they have this long-term competitive advantage, the more skeptical you should be. But I have found this framework just trying to think about, is this a good idea that seems bad, or is this a bad idea that seems good? I've found that has helped me make good decisions a bunch of times. This is sort of YC's mantra, but it's so important that I wanted to talk about it again. The best companies all have great products. Unfortunately, the current fashion in Silicon Valley, I think, has gone a little bit too away from this, and it's too much about growth hacking and sales and marketing machines and everything else. And that does work for a while. You can get away, actually for a pretty long while, by executing really well to grow a mediocre product. But you don't usually create like a Facebook-sized company by doing that. And I think asking the companies often won't have a great product by the time you're making an angel investment. But if you don't believe they won't get there at some point, I don't think it'll be a huge company most of the time. And here is the very simple framework I use for this. If I think about all of the most successful internet mobile startups, I heard about those because this is like true for enterprise and consumer apps. I heard about those because they were so good that one of my friends spontaneously told me about it. They were not being incentivized to. They didn't market to me. They didn't advertise to me. It was just like someone I trusted said, "You got to try this new thing. It's amazing." And if the startup is not going to get there, I think they will not be at that number one spot on your power law of returns. So I think this is like a really important filter. Related to that, and I mentioned this earlier a little bit, human intuitions about exponential growth are terrible. We clearly had no evolutionary need for this. We can like visualize linear growth very well. We can like, visualize the trajectory of an arrow very well. Very few people that I have met, actually maybe none, can sort of tell me what, like let's say 25% monthly growth, 1.25 to the 36th power is. It's like, where will this company be in 36 months? It's really hard. And it is how these companies get super valuable. So I long ago learned to stop trying to trust my intuition on this, and I just model it out. And I try to model the decay rate about how much I think growth will slow down. But I try to say, okay, given that this company is growing by word of mouth, how big can it be in 5 years? And yeah, I've learned not to trust my intuition on that. I mentioned this a little bit earlier, but I wanted to mention this near the end of the presentation. There are a whole bunch of words, a whole bunch of different ways that people talk about this. This is one of the most important concepts in startup investing. This is one of the things that differentiates investing in startups from investing in small businesses. You are looking for a company that gets more powerful as it gets bigger. You are looking for a company that gets increasing pricing power as it gets bigger. You are looking for a company that has an easier time getting more users as it gets bigger, that gets harder to compete with as it gets bigger. And this is often fairly obvious. Sometimes it's not. Sometimes you really have to think hard, but like once you do, you can come up with a story for it. This is something that a lot of people get wrong because they get caught up in, oh, this is so cool today. This company has discovered this wonderful thing. Almost all of the value in a startup is the revenue, the earnings it's going to generate in years 10, 11, and 12 from now. And so if you can't answer this, be pretty skeptical. And then finally, one other question that I like to think through before making an investment is, what do I understand that other people don't? There can be a lot of answers to this, but this comes back to not basing your decision too much off the decision of other investors. I like to understand, at a minimum, if I don't have an answer to this question, I don't feel like I have any competitive edge in that particular investment decision. But sometimes the answer to this question is just like, everyone's bullish on this company, but I'm more bullish because I understand this specific thing about this market. And everyone thinks it's good. I think it's even better, so I'll pay this very high valuation. But this is a question that I have found helpful for me in many scenarios. All right. Unfortunately, I took all the time, but maybe I can do like 5 minutes of questions.
We definitely have time for some questions. I just wanted to remind all the folks who are live streaming that the hashtag for questions is YCSIS. It's YCSIS. I think the beginning of the live stream might have missed that. So please do send some questions. And we started a little late, so we'll perhaps run a little long, and then we'll take a quick break. Thanks.
All right. Yes. What can early stage investors do to add a lot of value to founders? Almost, if you ask founders this, which they're the customer here, I think that makes sense. Almost always the number one thing they want help with is hiring. So helping them find really good people, help them interview. Back when I was sort of an active angel investor before YC, I would tell founders, you can use me as much as you want for interviews. I will help recruit, I will help source people, I will help interview, I will help close. I think people really like that. Help with future fundraising. And then help with just sort of everyone wants to provide the big strategic advice, and that is really valuable. I think one of the things that I did well when I was an angel investor was I would just try to be available all the time for tactical advice. So I would meet for the big strategic, what can this become advice, and that's fun. But I think a lot of the value comes just from being available at 11 o'clock on a Friday night when a founder needs a 2-minute phone call for some emergency. So super availability for tactical advice, I think, is good. What flaws are acceptable in a founder at a series seed or Series A stage? A lot. I think don't compromise on the things that don't get better. Don't compromise on founder integrity. But if you think the founder's improving fast, I think a lot. So I bucket this as traits that I believe can change and traits that I believe can't. And if the founder is improving quickly and it's something that I think is changeable. We've had many, many very unsophisticated founders but that were smart and wanted to learn and were, doing this for the right reasons, super mission oriented, come through these doors, and they have just progressed really fast. So, they were founders who I think had like no domain specific knowledge about, like one funny thing is when you are negotiating an investment, a lot of the time, a founder who's otherwise very good will have no idea because they've never done this before. And it kind of spooks you. You're like, wow, you don't know what like a valuation is. And that's the kind of thing that's like, that's a flaw that's okay. How do you judge for integrity with a founder that comes out of network? So in our experience, we have gotten this wrong a handful of times, but we have prevented ourselves from this mistake hundreds of times. Because even in our 10-minute interview, if you give like a founder a chance to sort of tell you about the unethical things they do, they will often do it. And yeah, surprisingly often. So I think the answer is you just listen to the decisions they've made so far in building the business. And if you're like, that's not a decision I think is okay, you can expect more of them in the future. But just listen in the first few meetings and you'll be surprised. We definitely have been fooled by plenty of people. But we also make our decisions in 10 minutes. Results-based observations about when to exercise pro rata and when not to. Several venture firms have done very sophisticated studies of this, and they have all come to the following conclusion, which is if the company is raising an up round led by a good VC, say a top quartile VC, you should always exercise pro rata. And if you do that across your whole portfolio, you'll be happy. Now, this could change if the world really changes, but in the world today, there's like very clear data on this. What's pro rata? So often when you invest in a company, you will get, not always, but often, you will get something called a pro rata right, which is a right in future rounds to invest enough dollars in the new round to maintain your ownership level.
You'll hear more about pro rata in the next session. Now that I have anything to talk about. Let me get a question.
Sure.
I'm going to give you a couple of them all at once. Can you please share an example of a good idea that seemed bad at first glance? If possible, one of your investments that is not a darling we all know about. And also, do you think security tokens and ICOs will change startup funding? We're going to talk more about that later.
All right. Do I think security tokens and ICOs will change financings? Probably, but not in the way that most people think. I think this idea that like everyone is going to just raise money from the crowd, I think we'll find out that we have securities laws for a reason, and that we want some level of that, and that the level of, I think like there are some incredibly important ICOs happening right now, but they are dwarfed by the number of sort of things that are between just incompetence and scams. However, I do think that it's possible that we just find a much better mechanical way to track the investments we do right now. So that's possible. A good idea that seemed like a bad idea. This is like one of our darlings, but I just like it's an example that sticks with me so much because they were in my own YC class in 2005. Was Reddit. So when Reddit started, I remember very clearly. Like telling my friends about it because I was like, oh, there's this site, and you can like find these links, and I remember people looking at me like, and they're good, well-meaning people, nice people. That is the dumbest thing I've ever heard. Like there's all these things already on the internet. This one is just like pictures of cats or whatever it was at the time, and there's no way you will ever make money on this business. So that's like. And there's other more famous examples, but that is the one that for me resonates very deeply because I heard so directly from people I trusted so much. And I remember like when they would say it, I would just be like, oh yeah, I guess it's not a very good idea. Like I had all this conviction that totally went away when people I trusted said something was bad. There's another common version of this problem, which is where there's an idea that seems good in the abstract, but everyone assumes that big companies will crush you. So Dropbox is an example of this, where when we funded them and when they were kind of getting going, everyone was like, oh, it's a perfectly nice product, but Google, Microsoft, whatever, guaranteed to crush them soon. All right, other questions? Yes. When Uber was getting going, there would be all of these articles that would come out, it felt like every year, where someone would say, Uber is not worth X, the entire taxi market is only worth, 10% of X. And so, and this kept going. And that is really hard, right? Because you don't have a sense for exactly how big the market is because it's growing so quickly. I think one thing you can do is look at like shifts in consumer behavior that are creating new markets. So, like, if you thought of Uber as a replacement for booking limo services, that was one thing. If you then started to realize that people had begun to use it as a replacement for taxis and then public transit and then car ownership, you could project forward, wow, this market is actually going to be quite big because all of this other consumer behavior is going to shift here. All right, a solo non-technical founder. I wouldn't say I never would. I've done it before. I think it can work. I do like it when that founder learns enough to build an MVP. Where I've seen that go wrong the most often is then the ability to attract, evaluate, and retain technical talent. And so we have a strong preference for founding teams that have at least one technical founder. We also have a strong preference for teams that have at least two co-founders. Again, none of these are absolutes. Because this is all about the power law, we are always willing to consider exceptions. So I would never answer a question like that and say I would never, but I would try to be clear, like, here's what I've seen work more often. What was the next question? Oh, a good amount of self-awareness. I think a good amount of like willingness to take feedback and a drive and a desire to improve is really important. But you do also have to sort of believe that you can succeed in spite of all of your flaws, and so that's almost more important to me than like someone who really spends a lot of time categorizing everything they're bad at. If they're willing to listen, willing to improve, I've usually found I can work with that founder. One more question in the back. How do you think about evaluating your time and resources to different founders? A self-indulgent way to do this, but one that works, is only fund founders that you want to allocate a lot of time to. Because if you don't, and if the founder is like difficult to work with or doesn't listen or you're just not excited about the business, A, that's probably a red flag for their qualities as a founder. And B, you won't spend time and you won't help them and you won't get this differentiated thing. So I won't fund a founder that I don't want to spend a lot of time helping, and that has always worked pretty well for me. All right, thank you all very much.
So just a couple of quick notes. Sam mentioned that you want to look for founders who understand that startup success can take as long as a decade or more. I think it should be obvious that the same thing is true for you all. Investing is not investing in startups, I should say, is not a get-rich-quick scheme. It requires both patience and the passion, the interest that is hopefully reciprocated by the founder. And the second thing I will point out, as someone who has done a lot of angel investing and compares his results to Sam's, that he's really, really good at it. So I hope you do listen quite carefully, or have listened quite carefully to what he has to say. We are going to take a short break. So please try to be back here by 11:15, 10 minutes. And then Kirsty and Carolyn are going to talk about investing fundamentals and mechanics. Thank you.
Yeah, no, we're here because our company is in talks with a couple of government for various things. Alliances, help with the buyout of the acquisition. And then we're meeting another investor in the afternoon and then another one in the evening. Let's see, hopefully something happens. Yeah, we almost got a huge buyout.
Thank you. And then can we also just check the slides?
Yes.
Which color you have, Christy?
Are you going to turn ours off when we're not talking?
Yeah, I'm gonna turn it off right now. Hey, what's up?
Not much. I just want to say hi.
How's it going? You know, doing a live stream thing.
Oh, you're doing the live stream.
Yeah, we're like just testing it out. How's your life?
Pretty good. Yeah.
Were you?
Cool. Yeah. So you're orange and I'm and then we're just going to have to jostle for position on here, aren't we, I guess?
Well, I'm going to go sit down. Like, when I'm not talking, I'm going to here.
Oh, okay.
Perch.
And perch.
Yeah.
Yeah. All right.
I probably what Craig wants to do is strap the microphone.
That's what it says. But if you hold it away.
That's true, but like, I want to clear my throat. I don't want to like,
Okay. Well, we should make the call now because now it's the rest of the I'll let him know. Hello. Hey, hey, Craig. Craig, push this on for me.
Yeah, which color is it?
Hello, everybody. Quick announcement. In the spirit of having kinks, apparently we have a couple of overflowing toilets. The one in the back is not working. The one here is working. If there is too long a line, you may go across the street. It's a 335. If you go right to the left when you go in, there are toilets. Please feel free. You know, that's called a big ass fan.
Yeah, it is big ass, man. And what is it used
That's literally the brand name. You know, it's
Great
not.
name.
Chill.
To cool it? To cool the place.
But we have better air conditioning now.
I guess you have this exposure. Yeah,
It's just one of those things we got a long time ago. I don't think we ever turned it on.
it's awesome.
It's cool though, right? Hello, hello, everybody. Please come take your seats. We're going to get started right away, please. Thank you. Hello.
Yes.
And they're not too particular about what kind of deal.
Okay, so first announcement is that apparently our toilets are closed here. There's a city problem, but it stops here. So if you need to use the restroom, please go across the street to 335. Give it 1 sec for people to come in. All right, this next session is actually one of my very favorites because there's so much mystery in the fundamentals of how you actually do a startup investment, what it really means and how it works. And there are no two people who are greater experts in that on the planet than my colleagues Carolyn Levy and Christina Thu, who have dealt with these issues with, I guess, thousands of companies now. It's certainly all 16 or 1,700 YC. What is the actual number? Probably no. Nobody knows. Anyway, hundreds of companies. They know this stuff better than anyone. Carolyn is the person who actually invented the safe. She used to be attorney at Wilson Sonsini before coming here, and Kirsty is the CFO of YC. They too have a couple of pithy quotes. You can guess who said what, because I don't know. One said, all investors who can help should do so. Asking for additional shares is just asking for a freebie. I'm guessing that's Kirsty, but I'm not sure. Having money is very valuable, but someone who helps with strategy and direction is priceless. So choose wisely. So with that, I will give you Carolyn.
Do you want me on? You're on purple. Yeah. Hello? Is this working? Okay. Yeah, I have no idea which quote is mine and which one is Kirsty's. And we were going to introduce ourselves, but since Jeff just did it, we will move right along. Like Jeff said, this is the mechanical part. Okay. This presentation is about how to invest using Y Combinator. Is my mic not on? Do people not? Lights on? Just on low. Better, better, better? Better? Okay, I think we're good. Okay, so as I was saying, this presentation is about how to invest using Y Combinator's SAFE, which is the first thing I'm going to talk about. And then Kirsty's going to describe how the SAFE converts in an equity financing. I'm going to talk about how the SAFE converts in other events. Quick word about process, and then we had some advice that Sam kind of covered, but we'll just reiterate it because it's important. Okay, so a lot of you raised your hand when Jeff asked, or Sam asked, how many people have already angel invested. So I'm wondering how many of you have already used the SAFE. Oh, that's a lot. Okay. Okay, so I'm going to talk about the basics. For some of you, that's going to be stuff you already know, but for those of you who've never used it, hopefully that will be helpful. It will be helpful. Okay. We drafted the SAFE for very early stage startups. So that means that the company maybe hasn't, or definitely hasn't raised a priced round, doesn't have any preferred stock outstanding. You absolutely can use the SAFE for companies that are later stage, that have already raised a priced round and issued preferred stock. In fact, some of you may have already done that. But we intended it for very early stage startups. A time when you may not want to use the SAFE is if you are looking at a company that has already issued convertible promissory notes to earlier investors. And if that's the case, you're going to want to go ahead and just use that same note, not use the SAFE. And that's because it's a lot less complicated for a company to have all of its investors on the same document, and it's also more fair to have all the investors on the same footing. So obviously, if you find a company you want to invest in and they are actually doing a priced round, you are going to invest in that priced round and buy preferred stock. But for the vast majority of early stage startups, they don't have a lead investor, they don't have a person setting the terms, setting the price of the round, and most of the time for very early stage startups, they don't even know what they're doing yet. And that's where the SAFE comes in, because for these very, very early stage companies, they just want to raise a little bit of money from their friends and from family and from angels. And with the SAFE, they can do that very efficiently, very quickly, and very cheaply, because neither the investors nor the company need to get legal counsel. Okay, the SAFE is an acronym, stands for Simple Agreement for Future Equity. As I said before, it is a convertible security. It converts into shares of the company's stock. The premise is very simple. You, the investor, give money to the startup right now, and at some point in the future, you're going to get your stock. One of the most important things, I say this a lot, the SAFE is not a loan. It is not debt. It does not accrue interest. There is no right to be repaid at some point in the future at some maturity date. So please don't call it a SAFE note. That makes me really crabby. Okay, what does it look like? I brought one. It's 5 pages long. Compare that to a set of financing documents, which is about 5 documents, and none of them are 5 pages long. They're all much longer. There are only 2 key terms. I'm going to show you. This is what the intro paragraph of the SAFE looks like. You can see that there are 2 blank spaces there. The first one is the amount of money that you're going to invest in the startup, and the second one is the valuation cap. Kirsty's going to get into detail about what the valuation cap is when she speaks next. But those are the only 2 things that you negotiate with the company. It is just that simple. After the intro paragraph, there is a whole section that describes the conversion events, which we will get into in a minute. There is a section of definitions, because it's a legal document. We always have to have definitions. And then the rest of it is boilerplate. And an example of boilerplate, company makes reps and warranties to you about the status of the company. You make some representations to the company about being an accredited investor. And then there's a really skinny miscellaneous section at the end. I want to point out what is not in the SAFE. For those of you who own preferred stock, have made an investment in a company and gotten preferred stock, you will know about voting rights and information rights and liquidation rights. Those are not in the SAFE because the SAFE is not yet stock. When your SAFE converts and you get preferred stock, you will be piggybacking on all those same rights that the lead investor in the round has negotiated for the preferred stock. So you won't find those things in the SAFE. So what you will find in the SAFE is pro rata, and Sam conveniently defined that for some of you who don't know, who didn't know what it was before. It's the right to buy more stock in future rounds so that you maintain your percentage ownership of the company. The SAFE has a section that says that you will get those pro rata rights in the next round, not the conversion round, but the next round. So if your SAFE converts in a Series A preferred stock financing, that document will bake in the right for you to buy shares of the Series B financing so that you can maintain your pro rata percentage. Okay, so what I've been talking about is what we call the capped SAFE. It's the one that has the target valuation. Kirsty's going to describe that in a lot more detail. It's the most commonly used SAFE that we have, but there are a couple of other versions of the SAFE that I'll go over briefly. There is something called a discount SAFE. Instead of negotiating that valuation cap in the intro paragraph, you and the company will negotiate a discount rate, and the discount rate will then apply to the shares when you convert the SAFE. Typical discount rate ranges in between 10 and 20%. So for example, if the Series A round that your SAFE is converting in is the lead investor has priced it at $1 per share and you've negotiated a 20% discount, your effective price is 80 cents a share. It's pretty simple. There's also an uncapped SAFE, which not very common to use. This has neither a target valuation nor a discount, so really you're just converting your SAFE into the same price that the Series A is paying. There's no reward for being the early money. That's why it's a pretty unusual SAFE to have, but occasionally a company has such great demand that they can get away with serving up an uncapped SAFE, so just be on the lookout for that. And then a third version is what we call the MFN SAFE. MFN stands for Most Favored Nation. It's a concept we borrowed from contract law. And there is no target valuation in this SAFE, but there's this MFN paragraph that says that if a subsequent investor negotiates a target cap, or rather a target valuation or a discount, you get to amend your SAFE to take the terms that that investor got. So then your SAFE is no longer uncapped. And now Kirsty.
All right, so now we're going to talk about how the SAFE converts, and we'll cover how the valuation cap works, the maths behind the SAFE converting, so this is going to turn into a maths class, and also how to understand your ownership. So first of all, the valuation cap. This is one of the things that, as Carolyn mentioned, is one of the things that you will negotiate with the founders. And you'll also hear it referred to not only as a valuation cap, but a target valuation, or just simply a cap. And the cap's the highest valuation that your SAFE will convert at. So if the priced round is lower than the valuation cap in the SAFE, your SAFE will convert into shares at that priced round valuation. And it's important to note that people get really confused with the cap. They think it's a current valuation of the company. That's really not what it is. All it is a way for you to be rewarded for coming in at the earlier stage when, in theory, you're investing at a riskier stage. It's the way for you to get your reward and your bonus. And so ideally, what you really should be thinking is, if I'm putting money in at this cap, then what do I think the Series A price, how much higher do I think the next price round's price is going to be? And ideally, you want that high, because then your reward is better. Okay, so your SAFE will convert into shares when the company completes an equity financing, i.e. a priced round. And different companies, depending on the stage of the company, that priced round might be called a Series Seed, it might be a Series A, or there might be some situations where they've already raised the Series A and there's some SAFEs bridging them to the Series B. So it's just whatever the next price round is. And we'll try to refer to it just as a priced round here, but sometimes it just slips in that it's a Series A, but it can be any priced round. And in that equity financing, the company, the founders, will negotiate with a lead investor in that round and will create a term sheet that sets out the terms of that round. And those terms don't impact how your SAFE converts, because that's set out in the SAFE itself, but what it does impact is how many shares the SAFE converts into, as we'll go over in a moment. And so when the priced round closes, three things happen. And in the documents, they're all happening at the same time. But in the calculations, they actually go in order. And you'll see why in a moment. So first of all, an options pool is created or increased if the company already has one. And usually the closing option pool, which is negotiated as part of the term sheet negotiations, it usually is around 10% of the post-round shares. And that's kind of what makes this calculation a little bit complicated, as we'll see in a moment. Next thing is that the SAFEs convert into shares. And although the SAFEs themselves don't state this, the term sheet will usually specify that the SAFEs convert in the pre-money. And what that basically means is that the shares that the SAFEs have converted into are considered when the price per share for the lead investor is being calculated. And again, you'll see that in an example in a moment. And then thirdly, the new money comes in. So the lead investor and anybody else who's investing in the round at that time will invest their money and buy their shares. Okay, here comes the maths. So at a very high level, for any investor, the number of shares that an investor will receive is the investment amount divided by a price per share. And the price per share is calculated by dividing a valuation by the shares issued by the company. And the shares issued by the company is otherwise often or always referred to in the documents as the capitalization of the company. And so for a safe holder, the valuation is usually the cap, and the capitalization is usually the issued shares plus the increased options pool. For the new investor, the valuation is the priced round valuation, and the capitalization is the issued shares, the increase in the options pool, and the shares that the safes have converted into. All right, here's an example. So on the left over here, we have an example situation. So we have founders who have 9 million shares issued. There's 3 founders in this example, and they're all sharing the shares equally. And at demo day in March, the company raises $800,000 on safes, and they all have the same valuation cap. They all have an $8 million cap. Then fast forward to November 2019. Often it can take that long, maybe even longer, before a priced round happens. And they raise a priced round, which is where they raise $4 million at a $16 million pre-money valuation. And the terms that are negotiated in the term sheet as well are that the options pool will be increased to 10% of the post-money, and the safes convert in the pre-money. And I'm not going to get into the calculation of how the options pool increase number works, because it gets very circular, as I'll show you in a moment. But just trust me that it's going to increase to this very not round number of just over 1.4 million shares. Okay, those are the details. So the first thing that happens, we've increased our options pool. The next thing that happens is that our safes convert. So the safe capitalization, as defined in the safe, is the issued shares plus the increase in the options pool, so 10.43 million shares. The safe conversion price is the valuation cap, because the cap is less than the priced round, divided by that capitalization to give a conversion price of 77 cents. So the shares that the safe investor buys are the $800,000 investment divided by this conversion price to give us just over 1 million shares. Everybody with me still? Okay, good. So then the next thing that happens is our new money calculation happens. So this is the lead investor in the priced round. So this time, the capitalization doesn't include just the issued shares and the increase in the options pool. It also includes the shares that the safes have converted into. So this time we have a capitalization of 11.4 million shares. And then the price per share is calculated, again, using the price per share, the valuation from the term sheet, the 16 million, divided by the 11.47 million shares to give a price per share of 139. And so that $4 million from the new money investors will buy 2.87 million shares. Okay, so bringing this all together, this is a very simple cap table. It's much prettier than cap tables normally look. So for those of you that are not familiar with cap tables, how this works is it's just a way of explaining the ownership of the company and who owns what and in what proportions. So here you can see that we have our 3 founders. They own common shares. Their numbers haven't changed. The number of shares that they have stays the same. We have our increased options pool. This is where the employees will be issued shares from in the future. And then we have our safe investor, who has their 1 million, approximately, shares. And you have the priced round investor, who has the 2.8 million shares. And these safe investor and priced investor has preferred shares. Founders and employees have common shares. So what you can see from here is that even though the safe investor has put in $800,000 of the total 4.8 million that the company raised, proportionally between these two investors, they actually have a much higher number of shares. And that's the cap coming into play, and that's how the safe investor gets the reward for their early investing. So that's how that works. It also shows percentage ownership, and you can see that my maths did work. Our options pool is 10% of the total post-money shares, which is the total of these two numbers. Now, safe investors have quite a hard time of it, because at the time that you actually sign your safe, you don't really know how much ownership you're going to wind up with after the priced round. And the reason for that is that even though the safe says how the safe's going to convert, it doesn't specify how many shares it's going to convert into, because that is dependent on the terms of the priced round. And so in this example, the safe investor has just over 7% of the shares. And the way you can think about it when you're signing your safe, if you're thinking about ownership, is kind of a rule of thumb of $800,000 invested at an 8 million cap gives an 8.8 million post-money valuation of the company. So the safe investor would own approximately 9% of that. But that assumes that the safes convert immediately on signing and there's no money. There's no new money. And that actually never happens. So the reason why this 7% is not 9%, is why it's less, is because the safes have been diluted by the new money coming in. And just as an example, to just explain a little bit more, if the terms of the priced round had all been exactly the same, except that the investor had only put in $2 million instead of $4 million, then the ownership here would be just over 8%. So that just tells you exactly, you really can't tell how much you're going to get until the priced round. Because that's quite difficult, it's important to do your own modeling and to think about how you, what scenarios could happen to explain your ownership going forward. And so there's a couple of things that we have shared with you to help with that. Jeff, wherever he's gone, has written some software called Angel Calc, and that is modeling software that allows you to see various different scenarios. And there's also going to be a spreadsheet that I'm going to put onto the resources page at the Investor School website so that you can play around with the calculations and you can see how safes might convert in the future.
Okay. Okay, so suppose you've invested in a company and before it raises a priced round, something else happens. And examples of what else could happen is that it could get acquired, it could fail, or nothing could happen. So I'm going to talk about those. Okay, I think it's easiest to understand what happens in the safe in a merger acquisition situation if you look at both extreme ends of the spectrum. The first one extreme end would be, a home run situation. And by home run, I think Sam mentioned this as well, this term. This is where an acquiring company is coming in and paying a lot of money for the startup you invested in. So what happens to the safe? Well, you are going to convert it into shares of common stock. You're going to do that by using the target valuation to determine the number of shares of common stock you get. and then you are going to participate in the proceeds of that merger along with the founders and the other common stockholders. In that case, you can expect a return that is well in excess of what you paid for your SAFE. This is also what would happen in an IPO, by the way, so same situation, same result, rather. Okay, other end of the spectrum is the Aqua Hire, and I don't know if this is a term that all of you in the room are familiar with, but this is a situation where an acquiring company is coming in and just taking the talent out of the startup that you invested in, so the founders and key employees. They are not paying money for the intellectual property or any other assets, and these are deals where there is usually very little money. In that situation, you are going to elect to have your SAFE paid off. So the SAFE gives you the option, and because most deals aren't at these two extremes of the spectrum, they're somewhere in the middle. What you need to do when you're confronted with this situation is actually do the math and figure out how you get the best result, whether it's converting into shares of common stock and taking in merger proceeds or just getting paid back. Okay. So sometimes a company raises money from you and other angel investors and just can't make it work. Hopefully they try really hard, but sometimes it just doesn't happen and they fail. And when failure happens, companies need to go through an actual dissolution process. And part of the process requires that creditors be repaid. In a dissolution situation, they need to pay off their trade debt, which is vendors and landlords, and they obviously have to pay their any employees they need to pay the salaries. If there is any money left over, the SAFE says that you are next in line. So if there's money, the SAFE holders and any other investors will get paid back. Often it's pennies on the dollar, but they get something before stockholders get anything. And honestly, in a dissolution situation, not only is there never any money for stockholders, but there's rarely enough to pay back investors either. This is usually just a total failure, and you can expect this to happen some of the time. What happens if nothing happens? So this would be a situation where the company has raised raised from angels and actually become self-sustaining, profitable, and they just putter along, and suddenly they have no desire to raise a priced round, and nobody's knocking at their door to acquire them. So what happens? Well, the SAFE doesn't address this, and there's a reason why the SAFE doesn't address this situation. Number one, when you try to draft for all these corner cases, it stops being a simple document and becomes a very complicated document and a very long document. And number two, this just doesn't happen very often. This is, in high growth world, this is extremely rare. But if you want to fund lifestyle companies, you definitely do not want to use the SAFE, because then you're going to have this problem all the time. If you have accidentally funded a lifestyle company, then I think our advice would be to go talk to the founders about it, because hopefully you invested in really good people and they would want to do right by you and figure out how to make you whole. That kind of goes back to Sam's point about being really careful about the founders you choose to put your money into. Oh, Kirsty's going to talk about process.
Okay, so we've talked about what the SAFEs are and how they convert, but now let's talk about the process for actually signing the SAFE and then also for converting it into the shares. So the first thing in this process is the Handshake Protocol, and the reason why we created this is to help to avoid misunderstandings. Founders are by nature very optimistic. And we've seen many situations where the investors said something like, yeah, I'm interested, meaning I'm interested in finding out more about the company. And the founder hears this as, I'm going to invest in your company. Cue lots of misunderstandings and confusion. So the Handshake Protocol is just simply a set of emails that sets out in writing the key terms and makes sure that everybody is in agreement. So the founder sends an email to the investor and says, just confirming that you're in for X dollars at Y cap, and then you reply to the email to confirm. And at this point, there's a handshake deal, and it's considered bad practice at this point to back out. And again, reputation is everything in this world. So, you don't want to be doing things like backing out because it can harm your reputation. And on the flip side, the founders are under no obligation to take your money until that handshake deal is completed. So especially in a hot deal where there's loads of people trying to get in, you want to run through the handshake deal process so that you know that you're actually going to be able to get into the round. And you can read more on this on our website as well. There's a slightly more detailed blog post about it, but those are the key points. Most YC founders will use Clerky to send and sign safes. And this is an online platform that uses the standard YC safe in a template form, and then the founders add the specific details for your investment into that template. And you'll receive a signature request through Clerky where you can review the details either in summary form or the full safe itself, and you can e-sign the documents. So you don't need to do it all in person. The founders will also include wire details at that point, so you have those handy as soon as you've signed. Sometimes the founders might use other platforms, and especially non-YC founders. There's lots of options out there. HelloSign is another e-signing platform, similar to DocuSign. Or simply, they might just download them from our website, which is this link, and send them to you in an email to sign and send that way. All of those work, it's just preference. So when you receive a signature request through Clerky or whatever other means, you should check that the details in there are what you previously agreed to. In addition, you should check that the name and signature block on the safe is correct, particularly if you're investing through a trust or through a fund or you've created an LLC. The founders won't always know the legal name if you haven't set that out specifically for them. So you should make sure that those details are correct before you sign the safe. Don't sign the safe and then tell the founders it needs changing. And you should be ready to wire the money as soon as you sign the safe. The safe isn't valid until the money is wired. And one of the things that when we ask founders what makes a good investor, one of the things that comes up a lot is that the investors sign and wire the money quickly. It's important to the founders that they raise their money and get back to work. And so, so investors that delay the process or that say that they want to invest and then say to the founders, oh, but hang on, because I just need to close my fund, or this company is nearly exited and I'm just waiting for the transaction to happen so I can get some money. Really, if that's the situation, you should probably not be talking to founders about investing in their company until you actually have that money available. Now, when your safes convert in the priced round, you'll be asked to sign more documents. And these documents will be the same documents that the lead investor has signed and will have been negotiated by the lead investors and their legal team and the company's legal team. And you'll receive an email from either the founders or their lawyers asking you to sign some documents. You may, at this point, need to ask them to send you the conversion calculations, otherwise known as a pro forma cap table, so that you can actually confirm how many shares your safes are converting into and see your post-money ownership. And you should definitely make sure to review that. The cap tables that we see, and we've now seen thousands of cap tables, it's surprising how many times the lawyers actually get the conversions wrong. So I really strongly recommend that you do review those cap tables and you make sure that you are happy with the calculations for how your safes convert. And now, sadly, you might not actually have much time to review these documents and to review the cap table. The founders will be focusing on the lead investor, they'll be negotiating with the lead investor, and they'll have set a closing date, and then they'll suddenly send you an email out of the blue saying, we need to close tomorrow, here are the documents you have to sign. And, yes, you want to be a good citizen and you don't want to hold up the closing, but also, this is your investment, and you need to make sure that you're happy and that you've reviewed the documents and that you, accept the terms in there. So don't sign until you are happy with those documents. All right, Carolyn.
Okay, so as I mentioned, Sam kind of already said some of this stuff, but I'll just reiterate because these are really important points. The first piece of advice, and this is what we meant about think about the upside. This is just Sam's power law point. If you believe in the power law and you invest that way, excuse me, then what you're not going to do is waste time negotiating downside protection, because what you've realized is that eking out a 1.5x return on all these little investments is not worth it when you're have the mindset that you're funding the next Google and that's going to be your 100x return. The next point we wanted to make is be helpful, and Sam also touched on this a lot. Be helpful when the founders ask. Sometimes angels write checks and they completely disappear, and sometimes angels write really, really small checks and then they pester the heck out of founders forever. Don't do that. Figure out, be the kind of angel that just gives the right amount of help. Sometimes angels think that they need to ask to be on the board of directors in order to be officially helpful, and you don't, and please don't, because it's actually not something the founders probably want. Sometimes, there's exceptions, but usually they don't want early investors on their board of directors. And lastly, tolerate failure. I think that all the other speakers in this course are going to talk about this a lot. I think it's really easy to get buyer's remorse when a company really starts to struggle, and I think that gets even worse when the founders decide to pivot, but you should expect and prepare for pivots. And remember, the safe is not alone. You can't go running in there and ask for your money back just because the founders start doing something different. You need to tolerate that, and you need to be supportive, and you need to give the founders a chance.
Okay, so in conclusion, we have covered quite a lot here, and safes, although on first glance look simple, can get quite complex. So if there's anything to take away from this, these are the key points. So use the safe to invest. It's the fastest and easiest method. Understand your rights as a safe holder and at the point of conversion. I cannot stress this enough, but understand your ownership and understand where that comes from. And finally, be patient. This is a long game. You're going to be with the company through highs and lows, and you need to see it out. So good luck to you all. I hope you all make lots of great investments. And I think we have some time for some questions.
Jeff, do you want us to take questions?
Yes.
Okay.
Please.
Do you want to call on people?
Yeah.
Repeat the question. Some angel investors feel that the safe does not adequately compensate them for the risk that they're taking. Even at a low cap, they're vulnerable to the strength of the subsequent money. So, for example, what Sam said about investing $70,000 and making $30 million would not have happened under a safe scenario. Do you hear that? What's your response to that?
So the question is, how do you make sure that you are fully rewarded? Is that what you were saying? Okay. So and the vulnerability of the cap to the subsequent money. So the numbers we're talking about here are an $8 million cap and a $16 million Series A pre-money valuation. If you're invested in the next Google, you're going to exit at $30 billion or whatever the number is. So whether your cap is 8 million and the Series A is 16 million, or whether your cap is 10 million and the Series A is 14 million, there is still a huge amount of upside there. And that's where you need to think. You're still going to get that upside because you still have that ownership from having that early valuation investment.
And also, you need to remember, you do have pro rata rights. And remember, Sam made the point, that you need to exercise those, because yes, you are going to get really, really, really diluted because you're the early money. But if you can't afford it and you can keep putting more money in, then when you have that liquidity event, you should recognize all that upside.
I think the question was directed towards the safe itself as potentially vulnerable, and I don't see that. I think that that's a misunderstanding of the way convertible debt or a safe actually convert into shares of stock. And again, as they said, I will hearken back to Sam's idea that it won't matter in the end whether you invest in a safe, a convertible note, or equity if you invested in Airbnb at 10, 15, 20, or $30 million. You'll still have the sort of returns that Dorio saw if you invest $70 million. You can do the math. Do the math of investing $70,000 in a company that becomes worth 10, 20, or $30 billion at a valuation of 10 or 20 million, and it will be stunning.
Okay, let's go the front here. Yeah. So the question was, who controls how much money the founders raise on safes? And what do you do as an investor if you sign a safe with, let's say, an $8 million cap today, and then the founder comes and signs another safe with another investor tomorrow at a $5 million cap? So the first part of the question, the founders decide how much they're going to raise on the safes. And you know, the advice that we give to the founders is to be very thoughtful about how much you actually raise on the safe, because you are selling the company. You know, you're selling part of the company. And so we counsel them to be very careful about dilution and to really think about that. So whilst the investor doesn't have a huge amount of say in that, the founders are thinking about how to make that work for them. The second part of the question is about the cap. And it's pretty unlikely that you will sign a safe with a valuation cap of 8 million, let's say, and then the next day they'll sign a cap with 5 million. Usually, you know, like Sam and Jeff have mentioned, there is some element of herd mentality going on in investing. And so if an 8 million cap works for other investors, then, you know, the next investor is likely to take that as well. Maybe there's situations where sometime further down the road, they might raise money with a slightly lower cap. And it's really circumstance dependent at that point. You know, there's nothing written into the documents to protect you from that unless you have the MFN provision in there. But, you know, again, we advise founders to treat people fairly. And, you know, if things have changed or something's happened, then you know, see what they can do to help their investors.
I get a question from online. It's one of my favorite questions, so I'm glad it was asked. What should a safe investor do when their rights are limited by a new lead investor? For example, pro rata rights only being given to major investors upon conversion.
We see this happen all the time. Oh, did everyone hear that question? Right. Okay, so what happens when the lead investor let's say you have a safe and it's converting into a Series A round, and the lead investor is not respecting the rights in the safe, for example, the pro rata right? You need to fight back on this. We see this happen all the time. We advocate, we tell our founders all the time, you do not get to ignore the rights in the safe. This is a contractual right. You're breaching the contract if you do not give the safe holders their pro rata right. This goes back to something Kirsty said too. It kind of sucks when they only give you 24 hours to read these documents, because you should immediately be going through and making sure that they did give you these rights, right? And you should also be checking the cap table to make sure that they converted your safe correctly. But so the answer to the question in short is find it, notice it, tell them that's not okay, push back on it, make them honor their contract.
And oftentimes it's actually the lawyers who are trying to make this more streamlined, and the founders either don't know it's happening or they haven't really registered. And so if you go and say to the founders, "Hey, look, you know, I should have pro rata rights here," then they'll be pretty willing to make that change in the documents.
Their reputation matters too, by the way, not just yours. So if they screw you over and don't give you the right that you had, that reflects poorly on them as well. Do you want to do more?
So the question was, should we consider investing as an LLC or as an individual for tax considerations and various other things? Well, so if you invest in an LLC, they're pass-through entities anyway, so the taxes would still roll up into your personal tax returns. And usually it just depends on circumstances. You know, if you're investing your own money, it usually makes sense to just invest directly, or if you have a trust, to be able to do it through that. If you start to be pooling money together, either amongst a number of investors or using other people's money to invest, then it makes more sense to create an LLC or some kind of fund structure.
Why usually the pro rata is only given to subsequential rounds and not only the convertible rounds? And there any way to do, like, to ensure that you have pro rata in this round, like a side letter or something like this?
Okay, so the question is, why is there no pro rata in the conversion round, and is there a way to get it if you want it? So the reason that we didn't put pro rata in the conversion round is because back at the time that we drafted the SAFE, this goes back to about 2013, seed rounds looked a little different. There was usually a shorter time in between the seed and the Series A. Things have changed a lot in the last couple years, and so we are actually thinking about, well, maybe we need to rejigger things. Maybe it should look different because the timing is now very different. But in the interim, what a lot of angel investors do is they do, just like you said, they sign a side letter and they say that they give themselves, you know, they negotiate with the company for a side letter to give themselves a pro rata right to not only have their SAFE convert into Series A, but then to purchase more shares on top of the conversion shares at the lead investor price. So that does happen.
Yes, I primarily invest in emerging markets other than China markets. So I often encounter this broadly about what happens if nothing happens. And most of my investments actually have been into convertible notes. One of them is today. Now what I like to see these days is that with the convertible notes, they do pay an interest. So you really are feeling a little bit of the pain because of the foreign interest like this. There also is an expiration date. So maybe these companies are generating revenues and it gives you a little bit of downside protection or maybe illusory downside protection that I'll be paid back at the next round of the next time. What I find very frustrating is with my safe investment, I'm worried exactly about that the investor is not in any hurry to raise the next round of doing as long as he gets the money. He's not feeling the pressure because I don't have the expiration date where he has to do that. So I'm not sure usually works well in those kind of markets where the subsequent rounds are a lot more important and take a lot longer. And that's my concern. Sorry, what do you think about it? I prefer
Well, you got to, I mean, if that works better for you, then you should continue to use it because it's just kind of all about your investment strategy and sort of your approach to it. I think in this class, you're going to hear a lot about the approach that Sam described. And for those kinds of investments, we think the SAFE works really well. But obviously, you're all going to have different strategies, and you need to use whatever instrument works best with your strategy.
a couple more online questions. First, when you use safes, do you need to use private placement memoranda? And I think I know what the answer for that's going to be. And this is sort of relevant to the previous question, but there was a question asked, do safes work around the world? Can they be used for investments anywhere?
I'll do the first one. So the question was, do you need a PPM, a private placement memorandum, to do a SAFE? And the answer is emphatically no. You don't even need a term sheet to do the SAFE. You don't even need a PPM these days to do a priced round. Nobody really does those anymore. SAFE is just one document. That's all you need. For a priced round, it's usually just a term sheet. That's all you need. So I haven't seen a PPM in years. So that's the answer to that.
And then the second question was, do SAFEs work around the world? And in general, the answer is yes. But there are some situations where they don't necessarily work. I know that we've heard some companies in India aren't able to use safes. I think it depends on who the investor is. They have to be on a certain list. And also, I think in the UK, they have sort of rejiggered the safe a little bit to make it so that it works more for the enterprise investment scheme relief that's available over there. But it's, if you are investing in other countries and you're investing in companies in other countries, then you should do your homework to make sure that it actually is a valid document in that country. So the question is sometimes this question has had safes that don't convert in the pre-money, and how common is that? Well, so first of all, it's getting less and less common that the safes convert at the same time as the round. Series A lead investors are getting more clever about this and realizing that if the safes convert in the pre-money, then the lead investors getting less dilution. And really all that's happening is if the safes do convert in the round, they'll just massage the valuations to still get to the same place that they want to be, which is usually around 20% of the company post-Series A. There was a second part to that question as well.
I will say that exact point is exactly what this gentleman was saying about pro rata. Because that is more of a trend that we're seeing that sort of argues for going ahead and having the safes also have a pro rata in the conversion round. So these things are all tied together. And again, I'll just go back. You said the primer doesn't do the math that way. Again, 2013, when it was drafted, things looked a little different and they've evolved. And so we are definitely talking about evolving the safe in certain ways to address that.
And just to reiterate, the safe itself doesn't mention this. It doesn't mention that it will be in the pre-money or it will be in the round. All the safe says is how do you define the capitalization to work out your conversion price for the safe itself. Okay, there's a question right at the back. Yeah. So the point there was that founders don't understand this either, and that's absolutely right. And again, one of the things that I spend hours and hours with founders as they're raising money at demo day and beyond is explaining to them how this works and how to think about dilution and how to understand what converting in the pre-money means and all these different terms. And at the end of the day, it's one of those things that there's only so much we can do, and if the founders don't want to understand it, then there isn't a lot there that we can do for them.
There's so many resources though, so maybe maybe everybody just needs to go to these resources. If you do the math and you do the pro rata, the pro forma cap table, and everyone agrees what that looks like, it is so much better. Everyone just needs to take the time to model it out. It eliminates so much confusion if you take the time to do that.
Is there, especially if you're investing personally rather than through an LLC, is there good case law around investor liability, especially in like healthcare startups or highly regulated?
Okay, the question is there case law around investor liability when you're investing as an individual rather than through a legal entity? There is tons of case law regarding stockholder non-liability for bad things that the corporation does. If the stockholders aren't liable, then certainly if you go even further out the circle and you just have people who put money in exchange for a convertible security, it's not a problem. So you're fine. If I understand your question correctly, you're fine.
One more question. Is there an optimal legal structure for the startup that you should want them to have before you
Okay, so the question is, what's the optimal legal structure for the startup? So for YC, we invest in mainly Delaware C Corps. For you signing safes, you'll probably want to make sure that the companies are C Corps. It doesn't matter if they're in Delaware or if they've incorporated in California or wherever else it might be. Obviously, if you're investing in foreign companies, then you'll need to do a little bit more homework because we don't necessarily know how all the structures work in all the different countries. We have seen some investments where people have invested into LLCs, but we don't really understand how that happens. So I would recommend that you stick with C Corps.
High growth companies are not LLCs. So
So maybe one more question from online. The question was about MFNs. Are those standard and safe? Could you give a little more color on how they work?
are MFN standard and safe? No, they are in the safes. The most favored nation that I discussed sort of in the middle of the presentation, those are not standard. Those go along with those are part of the safe that doesn't have a cap. So what this person may be asking is, can I negotiate a target valuation or a discount rate with a company and also have an MFN so that if someone gets something better, I can amend my safe after the fact and get that better term? It's kind of like what your question was, what happens if I do $8 million and next day another angel does $5 million? Can I get the benefit of that? We don't have that flavor of safe because I kind of feel like you make a bargain, you live with it, right? You get you and the company negotiate the best bargain you can get, the two of you, and then that's what you live with. So we don't have that flavor of safe up on our website. You can drop an MFN into the safe if that's what you and the company agree is fair. So it's possible. You could just cut and paste that paragraph right into a capped or a discount safe if you want to. I would counsel founders that that's probably not the right way to go, but you could try it.
Okay, thanks very much. Just a couple of quick things, and then we're done for today. Safes are weird and convertibles are weird. I had done over 100 investments, and I decided, not all safes, but mostly in convertibles, and I decided, I better figure out what happens when they convert. And I realized I had very little idea, as someone back there pointed out, that both investors and founders get really confused. As Carolyn said, there's a lot of tools now. I actually built a tool called Angel Calc that's open and available. It lets you very simply and quickly model what a safe conversion looks like, because it's worse than just the fact of whether, and by the way, Angel Calc always assumes it's in the pre-money because it's always in the pre-money now, almost always. And if it's not, I can't remember, I may have built something in to allow you to do it if it's not in the pre-money, but it almost always is in the pre-money. But it's much worse if there's multiple safes with multiple valuations, multiple different discounts, which is often not uncommon now. So as Carolyn said, the best thing to do is to model this, is to see what it really looks like, to work with the founders. Remember that. The question is to, what do you do if later investors try to screw you? I actually wrote a post about this called Transparency in Startup Investing. And I think what you ought to do is you ought to ask for anything that you should. I actually provide a form that you can send to the founder and say, or to the entire team sending you the update that says, hey, are any of my rights changed from my document? And if they are, then you should have a conversation, not with the lawyer, not with the VC, with the founder, who, remember, has a relationship with you, I hope. You are the first best investor, the person who believed in them before the rest. It's going to be hard for them to look you in the eye and say, screw you, I took away your pro rata. Again, I think you need to be careful with these. You don't want to screw up their deal, and you want to be a great investor, but it is fair, and they have the power in almost every case, to go back to their investors and to the lawyers and say, why are you doing this? Kirsty's the best investor I've had. How are you taking away her pro rata? The other thing I'll say about lifestyle companies and why I think the safe is preferred in general to debt is because we've seen too many times where the fact that there's debt there is used to kill a company that didn't have to die. And it's too easy for investors to call that debt when it's not payable. And we tend to be on founder sides. That might sound weird as investors, but it turns out that if you end up on the founder side more often than not, then your probability of getting in the one company that will make all those other investments irrelevant is much higher. We're done today. Tomorrow we're going to be kicked off by Dalton Caldwell talking a lot about founder meetings, which is going to be a great session, I think. And then after that we have two amazing presenters. Paul Buchheit is going to talk about in his sort of epic investing career what he's learned. And then I'm going to have a brief conversation with Michael Seibel, the CEO of Y Combinator. Thank you all very much for coming or live streaming, and we'll see you tomorrow.